Hi everyone, Demir here from Westmount Wealth Management. Today we're unpacking one of the most fascinating and misunderstood questions in investing. Is success about skill or is it just pure random luck? Like a poker game, the stakes are often rather high, the players tend to be confident, but sometimes it's the rookie who scoops the pot with a lucky river card. Investing can feel the same way. So let's break this down. The math, the myths, and the reality check for your portfolio. Before we even get to luck, there's some simple math which we cannot ignore. Nobel Prize laureate William Sharpe's famous paper, The Arithmetic of Active Management, makes it crystal clear. Before costs, the performance of all active managers as a group must equal that of the broad market. After costs, they must lag it. That's not cynicism, it's basic, simple arithmetic. Some win, many lose, and the average active investor falls behind after fees, taxes, and trading costs. Now, here's where it gets rather interesting. Nobel laureate Eugene Fama and his contemporary Professor Kenneth French looked at decades of mutual fund returns and compared them with thousands of purely random portfolios. Their findings: very few active managers delivered returns that couldn't just be explained by pure random chance. And even those quote-unquote winners, their streaks didn't persist once costs were factored in. It's poker all over again. A few hot hands, but really no guarantees. Michael Mauboussin calls this the paradox of skill. As everyone gets smarter, the differences between competitors tend to shrink, and when skill levels converge, luck takes over. In markets where information flows instantly and competition is rather fierce, proving true skill is nearly impossible. Statistically, even a manager who beats the market by 2% a year would on average need more than 3 decades of data before you could confidently say that it wasn't just luck. By then, that manager is probably retired or sitting on a yacht somewhere. Think of coin flipping. Put 10,000 people in a room and 10 people will flip heads 10 times in a row. It looks impressive, but surely you wouldn't say that those people are skilled at flipping that coin. It's just math. In investing, hot streaks can be exactly that, streaks. So why do investors continue to chase the hot hand, the star managers? Storytelling and the fact that people hate being average. We love the idea of genius strategists spotting what no one else can. But history shows us that by the time we can prove genuine skill, it's already faded. It's like sitting down at a poker table because one player has been hot all night, only to watch them bust before dessert arrives. Here's a reality check. The S&P Indices versus active, also known as SPIVA reports, drive this point home. As of year-end 2024, over 85% of US large-cap managers and more than 80% of Canadian equity managers underperformed their benchmarks over a 10-year time period. Short-term luck can disguise this, but in the long run, the math will win. Well, if skill is rare and fleeting, what should investors focus on then? Quite frankly, it's the controllables. Number one, cost. You should be favoring lower fee options as fees compound against you. Tax efficiency. You should be keeping your turnover low to hang on to more of your returns, i.e., you shouldn't trade too often unless it makes sense to do so. Number three, diversification. You should be spreading your risk across sectors, geographies, as well as asset classes. Number four, and perhaps the most important, is goal alignment. You should measure your success by the progress toward your own personal goals, not by beating a random benchmark or your next-door neighbor. Here's the bottom line. In the short run, luck can make a novice look like a genius or make a pro look like a fool. But over time, costs and competition make enduring skill incredibly rare. At Westmount, our approach is rather simple. We lean on evidence, we diversify broadly, we control what can be controlled, and we align portfolios with what actually matters, which are your long-term personal goals. Because, look, in investing, the goal isn't to outplay the table, it's to play the odds intelligently and to stay the course. Thank you for watching, and as always, if you have any questions, you know where to find us.